When you're trying to assess the risk of an investment in common stock, there's a handy tool that financial economists have developed. What they do is they divide the current market value of a company's stock into two parts. That associated with its current operations or its current business, and that associated with what are called growth options. And I'll make it clearer in a minute what the growth options are, but first let's talk about what the value of the current operations is. Back during the technology boom of the late 1990s, Charles River Associates, a consulting firm, developed a simple approach for valuing the current operations. What they did was they relied on consensus earnings forecasts for the next 5 years as step one. And then in step two, they said after 5 years, the company would just grow at the same rate as the overall economy. And they defined as the value of current operations those two parts, the 5-year forecast plus growth at the economic value from then on. And notice that's a pretty fulsome definition of current operations. It doesn't include what the company is currently doing, but what it's forecast to do over the next 5 years, and then growing with the overall economy from then on. That was the definition of current operations. Now, the growth options are everything else, things that the company might do sometime in the future. For example, in the year 2000, the iPhone, which wasn't even a dream in Steve Jobs' eye yet, would be a growth option. So the way you compute the value of the growth options is you look at the market value of the company's stock, and then you subtract off the value of the current operations. And this division is useful because the current operations are sort of anchored in reality, whereas the growth options are based on dreams and expectations. And dreams and expectations can rise up and collapse down quite easily. Let's look at an example from the tech boom back in the late 90s. And this first chart here shows the division between current operations and growth options for Yahoo, which is a poster child of the tech boom. And you can see that during the tech boom and collapse, Yahoo's value of current operations was pretty close to zero the whole time. But the value of the growth options went from near zero to almost $200 a share, and then all the way back to near zero. So you can see the tremendous risk associated with growth options. Now you might say, well, isn't this true of every company? And the answer is no, it's not. Here's a counterexample from the same period during the tech boom, Boeing. The value of Boeing is almost all current operations, as the Charles River Associates defined it. You can see that throughout the period, the total value of the company equals approximately, the red part, and I should have explained a little bit further. In the graph, the blue part is the growth options. The red part is the value of current operations. So in the case of Boeing, it was almost all current operations, and there was no boom or collapse in the growth options. Well, does this have any implications for investors today? And we think it does. Now, today isn't like the late 90s. The big tech companies all have significant current operations, but they also have huge market values. So how much of that is current operations and how much is growth options? Well, we've done an example calculation for 3 companies, Amazon, Netflix, and Snap. And if you look at the final exhibit here, you can see that for Amazon and Netflix, only about 30% of the value comes from current operations. That is what it's projected to do over the next 5 years and growing with the economy thereafter. For Snap, it's only 15. So if you're an investor in Amazon, for example, today, you're buying more growth options than operations in place. Maybe that makes sense, but it entails a good deal of risk. If expectations regarding those growth options changed, the stock could drop dramatically.